We've seen, as mentioned, a spectacular 48% decline in the last 6 months. And I see this trigger as being primarily a result of expectations of a Fed rate hike and the global short squeeze in the dollar that it has prompted. The world has been borrowing in cheap dollars in the hunt for yield over 5 years, and the threat of a rate hike is unwinding positions in the dollar market very rapidly. So that strength means you need less dollars for that barrel of crude. If you look at the historical relationship between the price of WTI and relative dollar value, current USD strength warrants a $53 handle on crude.
Here's some themes based around short-term and longer-term, and maybe that's the right cut. I'd first like to turn to James and ask, you heard Gregory link these movements in the oil price to the movements in the dollar and expectations of Federal Reserve Board policy changes. What do you think of that argument? Is there any leverage in that?
Well, it's plausible that the dollar move in particular is relevant, but it's odd that this didn't happen last year. So last year we had the taper tantrum, which saw some very big moves in bond yields in the short year in Fed rate expectations, basically moving the bond yield a lot from last May onwards. And that didn't lead to a crash in the oil price. This year, for some reason, it has. It's the coincidence that June was the point at which both the dollar took off and oil started plummeting is too great to overlook. But the fall has been a lot more than that. And the fall is obviously suggesting some serious problems. So whilst I think the dollar does have a partial explanatory effect and possibly even a trigger effect here, it's not the full story. And of course, we'd already heard about some of the supply issues, but there are lots of I do think the big shift by the Saudis to change the way they react to weaker demand does have a big effect.
Thank you, James. Turning to the longer-term themes, when I was listening to Ben and to Rado, going back to the 1980s.